What with the relentless tsunami of news these days, stories that shocked us only weeks before are swept from our memory. The fears they raised are soon replaced by new stories and new fears. Take, for example, the banking crisis of 18 months ago. The runs on Silicon Valley Bank and Signature Bank, the collapse of First Republic, and the liquidation of Silvergate Bank, all in a space of 60 days, shocked the financial world. Those failures include 3 of the 4 largest bank failures in U.S. history. The assets of these banks were 75% larger than those of Washington Mutual Bank, whose collapse ushered in the great financial crisis in 2008. How long has it been since you saw a story about these huge events? Our awareness of them was quickly swept away by threats of default on our nation's debt, chaos in Congress, war in Europe and the Middle East, and the drama of the 2024 elections. Concerns about the stability of our banks are rising again. Why? Because interest rates are rising again. High interest rates were a primary cause of last year's bank failures. Expectations have been that the Federal Reserve's tight money policies would finally slay the inflation dragon. These expectations seem to have been met last month when falling consumer price inflation led the Fed to lower interest rates by half a point, with as many as 3 more cuts expected by year end. But interest rates didn't fall after the Fed acted. They actually rose. Inflation didn't rise, yet interest rates rose anyway. Why? Because expectations changed on a dime. After the Fed acted, the government reported new data showing the economy was hotter than expected. Also, attention turned to U.S. government debt and rapidly rising government debt worldwide. Perhaps most worrisome, the presidential candidates launched a bidding war of tariff hikes, tax cuts, spending increases, and attacks on Federal Reserve policymaking that promise higher deficits, faster inflation, and a resumption of rising interest rates. This is bad news for troubled banks that bet on sustained low or falling interest rates. Maybe these concerns will abate after the election or after the new president releases their budget early next year. But be aware of the prospect for trouble in the banking sector. What does this mean for you? First, make certain your deposits are insured by the Federal Deposit Insurance Corporation. If you're not certain, call your bank and get an answer. Second, if you own shares in a bank, check its vulnerability. While depositors are protected by the FDIC, shareholders are at risk, even to the possibility of losing their entire investment. Third, be aware that markets hate uncertainty. And today, with war spreading in Europe and the Middle East, tensions rising with China and North Korea, escalating political instability in the U.S. and Europe, economic deterioration in China and Europe, and great policy uncertainty in the U.S., the world faces uncertainty unmatched since the 1930s. There's a reason gold prices have almost doubled in the last year, far outperforming the S&P 500, the NASDAQ, and the Dow. For thousands of years, physical gold has been the port individuals have sought when their worlds are swept by political or economic hurricanes. There is wisdom in taking such precautions, borne out by survival stories of people who were protected. You too can protect the people you care for with the safe haven that physical gold affords.